here to tell us the dog stocks of the day and give us his lowdown on the companies we should keep well clear of in our portfolios is our favourite investment expert, Roger Montgomery. Yeah. Let's talk about the companies that you rate them as C5s. Like your favourites are A1s.
Yes.
And your ones you don't like are C5s.
Yeah. Now there's two aspects to the scoring. I got a lot of questions last week about what this A1 means. Yeah. The A, Bs and Cs is based on a probability of what I call a default event. So the chances of a capital raising, the chances of a so we've got a capital raising, a default on a loan. There might be a liquidation. There could be, a company could go bust.
A CEO might leave under strange circumstances.
Well, I don't know about that, but that's not a default event.
Okay.
So a default event would be a financial event.
Okay.
Now, the Cs have the highest probability of that happening.
Okay.
Doesn't mean it's going to happen. They just have the highest chance of that happening.
Yeah,
Correct.
yeah.
So New Farm, New Farm last week had their big downgrade and shares have dropped from sort of $13 where the takeover bid from Sumitomo was all the way down to sort of $3.40 now.
Gee, some people would cheese off about that.
They were a B5.
They were a B5.
So they were a B5. Now 5, if I put together a portfolio of what I call value stocks, some of those value stocks are companies that there's a very good reason their shares are cheap. I don't want to own the ones with a very good reason. 5, there's usually a very good reason. 1, there's no reason. I want to own A1s or B1s. I don't want to own C5s. Now, what's surprising, I think last week...
Do you have A5s?
You can have an A5. Go A1 to A5, B1 to B5.
But you'd rather a B1 over an A5?
A B1's better than an A5.
Okay.
Yeah.
Very important.
Yeah. So look, it'll all be disclosed one day, I'm sure.
Okay. Let's kick off the first one.
Some of these are going... What you asked for last week were companies that were that people thought were blue chip. And then you described to me what a blue chip was, and you said that companies have been around a long time, they've got a great reputation, they pay constant dividends or consistent dividends. They're just regarded as sort of core portfolio inclusions, I guess.
Yes, exactly.
You want to contrarian...
think some of those are C5s?
Oh, yes.
Okay, and that's good.
And I've ranked them
This
here...
makes this spot more valuable than normal, mate, by the way, but go on.
I've ranked these by market cap. So the biggest market cap first, running down. Okay, so Westfield gets a C4. Okay, Westfield gets a C4. Transurban...
Frank won't like that,
No, I'm sure he won't.
I might get Stephen on the program.
Can I just tell you?
In fact, I might get Stephen on the program.
Frank and his sons won't care. So I don't think they'll care what I think.
Okay.
So C4 for Westfield. Transurban gets a C5.
And a lot of people talk about Transurban being a good buy now, don't they?
Well, there's some pension funds in Canada that seem to be very interested in it, and their advances were rejected by the company, but they get a C5. So my view is someone wants to come along and pays a crazy price for a C5, let them have it.
Okay. So you want to run through the names first, and then we'll talk about them as well.
Asciano, Incitec Pivot, Lease, the Goodman Group, where are we? Intoll. Intoll. Yeah. Primary Healthcare, 10 Network, Connect East.
10 Network with MasterChef.
Yeah, look, you can't buy you don't buy an airline because it's got one good plane, and you don't buy a television station because it's got one good program. Sure, but it's not going to last forever, is it? Nothing lasts forever. Prime Infrastructure, Transfield Services, AWB. What else have we got? Charter Hall, Energy World, Virgin Blue, Guns. So Sigma Pharmaceutical, that's not a surprise. The list goes on and on. It goes all the way down to these.
So you've got lots of C5s. You've got lots of C5s.
It's interesting. I think the reason why these stocks are purchased at all is because there's the promise that they'll improve. And remember, this is a snapshot in time. I could give you the ratings going back 10 years. Yeah. The banks, for example, at the moment, the banks are all A4s. They're all A4s, A3, A4. Yeah. 5 years ago, they were B1s, B2s. Now, what's happened is their performance has deteriorated for obvious reasons, and they've beefed up their balance sheet by raising more capital. So they go from a B to an A, but their performance has dropped, and they've dropped from a 1 and a 2 to a 3 and a 4 or even a 5 in some cases.
Yep.
So I can go back in time. This is just a snapshot, and when the 2010 results come out, they could all change again. If they've raised money, they'll go from a B to an A. They'll go from a C to a B, for example. So Lend-Lease is probably a cornerstone holding for a lot of people in their portfolios, and I wouldn't be surprised if
for diversity they could have easily been.
And the majority of advisors would gladly put people into Lend-Lease and own it for a very long time. But this business generates returns on equity that are mediocre.
Yeah.
Its return on equity it's going to be about 11%, 9% for 2011, and 10% forecast for 2012. Now they're not bad. It's not losing money, but it's not making phenomenal returns on the money that's been entrusted to it. They've been doing a better job. They've been buying back shares, which is a good thing. Their debt's only gone up slightly in 2009, and if you have a look at their value, what they're actually worth compared to their price, well, their value is about $5.47 versus a share price of about $7.30 or thereabouts. So they're trading at a bit of a premium, mediocre kind of performance in terms of return on equity. I think that'll improve in time if they continue with what they're doing on the capital management side. What I'm saying is the risk on this series of quantitative measures that I use, the risk for a company rated a C is higher than a company rated an A. Now, within C's, there's a whole band as well, you know, and you've got and Lend-Lease arguably is at the sort of the B-C borderline. It's not.
So it's not really a C5.
It's not a rubbish C5 if you like. Let's talk about Asciano because it's second.
Yeah,
it's the third
and a lot
biggest.
of people like Asciano because
Sure.
they think it's been pilloried in the press. It carries a lot of debt. But they think that a lot of people think it's got potential when the markets come back. So talk to that.
Yeah, okay. Well, it's often used as a sort of a proxy for the economic progress of of Australia. Here is a business. Let's start with its intrinsic value. Here's a business that's trading at about $1.72 or thereabouts. Its intrinsic value this year is 65 cents and 80 cents the year after. So it's trading at double what I think its intrinsic value is. The real story, though, is the capital history for this company. And its return on equity. We're talking about a business that earned a return on equity in its first year of 24%. This is the first year that it listed.
Yep.
Fell to 17% last year. Is forecast to go to 3.7%. And that's less than what you can get in a bank account. So let me ask you, if I was going to give you, and we're talking about an investment of equity of $2.4 billion, debt of $5 billion, and you're getting a return of 3.7% on your equity, with all that potential from the debt. You could borrow money and you could go and employ it. You can borrow the money and put it in a bank and get a higher return than what's happening here.
Now, Roger, if someone's watching this program now and they're long Asciano, and they go out, so on Roger's advice, on Roger's observations, I'm going to go out and sell. And you're not telling them to do that. I know that. But what in your estimation, the likelihood that Asciano could actually see a big share price spike over the next year?
Well, this is the thing, and I've always said to you, Peter, one of the things I can do, I can tell you what a business is worth, and I can give you a fairly confident idea about its quality. What I can't do, and I'm singly the worst person in the world at this, and that is forecast what the share price is going to do. The price in the short term is a popularity contest, and I've talked about this before, but in the long term, price follows value. So it's very, very important that you know what the value of a business is, and if you really want to sleep at night, then why wouldn't you just stick to the higher quality businesses, the ones where there's absolutely no shadow of a doubt that they're great quality and there's no chance of a default event.
We're running out of time. Westfield. We should talk. A lot of people hold Westfield. What's your view on Westfield? Why are you negative on it?
Well, look, I'm not negative. The business generates huge amounts of cash. The issue is if anyone opens up the balance sheet and has a look at the balance sheet, they'll find that current liabilities significantly exceed current assets. So you call that what you want, but that's one of the inputs into the quality rating that I use. I'm looking for businesses that have current assets significantly in excess of current liabilities.
Okay.
That's reversed with Westfield.
And how do you value that company now?
Its value is significantly less than its current price. And that's because the return on equity that it's going to generate is, again, 8% over the next couple of years, which is only a little bit better than what you can get in a bank account. And its intrinsic value at the moment, $6.79 this year, $7.05 the year after, $7.57 the year after that.
It is.
Well, it's closer to $13 at the moment.
Yeah, mate.